Welcome to Investors Insights. Our topic today is low on energy, high on jobs. We've got a great discussion here today. Several of you are still talking about the price of gasoline at the pump, and also from the standpoint, what's this economy look like, and are we still hiring people as we approach the holiday season? That's important in relation to the economy, the stock market, your overall portfolio. I'm joined today by my distinguished colleagues who I think the world of and enjoy working with every day, Trey Booth and Ty Miller, both of which are on our portfolio strategies team, and Trey is our chief investment officer. So with that, gentlemen, I'm excited to go over these topics today. And Trey, let's start with you. Elaborate what you were talking about energy.
Yeah, thanks, Greg. So some big news today that the G7 plus Australia have agreed to put in a $60 price cap on barrels of oil from Russia. And why this is impactful is that oil is currently trading around $80 a barrel. So that means if these countries are going to buy oil from Russia, they're going to get it at a deep discount. So that would force Russia to sell at below market prices. Now, this story ties directly back to a story we discussed last week where China may be increasing its chances of lockdowns to fight some uprising and some protests in that country. Now, why does that impact this story? Well, the G7 plus Australia that have agreed to this cap, that cap really only has teeth if other countries come along with us. If Russia is able to get around and sell oil at $80 a barrel to the likes of China or India, then there's really no impact to this G7 agreement because Russia will still get the $80 barrel. So if China, however, is locking down their economy, then they're not buying as much oil, and this will have a much bigger impact on Russia and hopefully weaken their military strength in what is the ongoing battle with Ukraine. So these two stories are directly linked. Russia's ability to circumvent any kind of sanctions through China has been a large perceived driving force of Russia's continued economic success in spite of all of the developed world really trying to cramp down on their growth. So something we're watching closely is to see this give and take of oil. So we're seeing oil actually rise today on this news, not fall. You would expect potential price falling as a $60 price cap on what is the second largest export of oil. So something we're watching closely and how it may impact U.S. consumers as they drive around for the holiday season, go see family and friends. The price of gas here in the U.S. may be directly or indirectly impacted by this. So something we're watching closely as the news breaks.
Trey, really appreciate those comments. Very insightful. Simultaneously, Ty, you knocked it out of the park this morning with jobs information as we're in this holiday season, last month of the 2022 year, and really want you to elaborate on jobs and how it relates to people's portfolios and the overall economy.
Yeah, thanks, Greg. So I think the best way to kind of describe this jobs report that I've been listening to is, it would be really good if we were in the right environment. And right now, we're just not in that environment. It's not a terrible report. It's kind of a mixed bag. Unemployment low. You would think that's great, 3.7%. We have wage gains. Wage gains were up 0.6% month over month. They're up 5% for the year. All of this is good stuff. Unemployment low, workers making more. However, payrolls up 263,000. That's all good news, but we've kind of, with this environment we're in where the Fed is hiking, we're seeing wage gains of 5%. They're saying that's probably too hot. That's tied into inflation. We're going to need to do another 50 basis point hike in December and kind of evaluate 2023. We can't have wage gains that high. The participation rate fell. That's the amount of people that are actively looking for jobs that fell again. We need more people looking for jobs to kind of relieve some of the stress on the supply chain issues. We're still trying to catch up in the leisure and hospitality space. As you can see in this chart, this is where we were pre-COVID, and this is kind of where we are now. You can see that we have gained a little bit, especially in some areas, but we're still trying to play catch up in the leisure and hospitality space. That's kind of our theory of, goods inflation and everything came on pretty strong. We're trying to recover in that service area, and we're still trying to make up that ground. So overall, pretty mixed bag. The next jobs report we get will be next month. So hopefully we can see some things that will lead the Fed to believe that they don't have to hike, as much or as, as viciously as they have.
I think as we continue on to end the 2022 year, I think people need to keep up with your comments as to what you're saying in this blog. Well, folks, hopefully you've gotten some great information here today. We hope this has been well worth your time. We can't believe that we're approaching quickly the end of 2022 year. We thank you for the belief you've put into us at Five Plan Partners, and know that each and every day we want to communicate with you like this, in person, on the phone, also through Twitter, Facebook, LinkedIn, our podcast. Please listen. We got some good things coming up on the podcast and YouTube, and we're going to keep you constantly updated as we end the 2022 year. We thank you and know that each and every day we come into this office here at Five Plan Partners, striving to make our clients' lives better, richer, fuller. Thanks.